Overall, do you think the factor that's weighed on bank stocks the last 3 or 4 months is people's expectations of what the U.S. economy might do next year?
Well, it's really twofold. Wilfred, you have the fear of recession. You had the yield curve flattening significantly through the fall, and then as we came into this back end of the year, and that kind of got people's anxiety up. And we saw some slowing in some of this uncertainty in the economic variables across the world. So all that came into play when we started looking at recession. The second thing was the banks this year in transition from the catalysts that they had over the past couple of years, which were lower deposit rates, efficiency gains, and lower credit costs, to have to move over to some new catalysts that the market really hadn't kind of got their bearings on just yet.
And so how does this play out for their earnings next year? Clearly, their price-to-earnings valuation multiples have come down a lot. Do you think earnings can reignite an improvement in those valuations next year?
Oh, we do. 2016, we had the same type of anxiety over recession, and it was followed by a great year in 2017. We think we'll go through 2018 where we have this transition. We still think the banks can generate double-digit earnings growth next year as we deploy more capital. We get a little bit more loan growth, and we can actually see asset yields starting to move higher.
Marty, it's Joe. Do you think at any point we're going to see some M&A for the banks?
We will eventually. We're not through with
I've heard
after
that for
a
the
decade.
last couple of years.
Yeah, that's right. But it's still, we've been talking about it being off in the future because the recovery is still in place. As long as these banks can generate the kind of profitability improvements that we're seeing here, there's no need for them to have to look around and consolidate. So a lot of the big players still have, like we said, gas in the tank and can push their returns higher and EPS up at double digits. So that's not going to push them into the acquisition game at this point.
Marty, Tom Farley here. What's going on with Goldman Sachs? They're down 40+%, trading at 80% of book value. How much more can they be beaten up? Is this an opportunity to go in and buy Goldman Sachs?
We think it's an opportunity, but it's not a short-term opportunity. You have to watch, what Wells Fargo went through the last couple of years, or even what J.P. Morgan went through with the well issue that they had. It takes years to kind of work out of these reputational issues. So we think that Goldman Sachs is definitely a long-term buy. Value is definitely compressed relative to the franchise value of the organization, but it will take time for them to come out from the back end of this. So we think, a 12 to 18-month time horizon is the way to look at Goldman Sachs at this point.
Marty, how important will their earnings be? Because David Solomon will be on the earnings call in a way that Lloyd Blankfein never was. Can he come out and allay some of those fears in the short term? Because a lot of analysts like yourself have mentioned, we'd like to hear from him. He's the kind of one that can come out and make us think, yeah, this is just going to be a fine. It might be a big fine, but we're not going to see, jail time or anything spread more widely across the firm.
That'll definitely be a help to be able to get some transparency and some communication going on with what's kind of happening behind the scenes, or at least as much as they can share with us. But really, earnings, when you said how much is earnings going to matter, Goldman Sachs earnings are 20% higher this year than what people thought coming into the year. So it's not about earnings. The fundamentals have been there. We do need to see some strategic direction on what they're doing on their consumer lending and their internet banking. And so as they're expanding their banking operations, we really need to see what direction that's going to take, because that's kind of been tossed up. So we can see some direction there. We can hear more about the details of this reputational issue, and the earnings can continue to kind of plod forward. That's where we think 12 to 18 months from now, we're not going to be below our tangible book value.
Marty, it's Joe again. Just following up on the Goldman Sachs question, not calling for the full repeal of the Volcker Rule, but basically, do the banks need a relaxation on that Volcker Rule to really have the ability to grow?
You're the first person to ask me about the Volcker Rule. I talk about that all the time. It does not affect the money center bank's earnings. Actually, it makes their earnings much less volatile, which is a great thing for them, and for us to have to forecast it, because we don't have to guess who was right or wrong on the market in any particular quarter. What it hurts more is this volatility, because we can't have market participants going in and adding capital and allowing for some of this trading to clear without having to find the other side of the trade when they're kind of sitting behind the scenes and not wanting to jump out yet. So I think it's created a little bit more of the volatility that we see. But all in all, it really does help their earnings in the sense of much less volatility.
Are you factoring anything about the new leadership in the House in terms of
you mean Maxine Waters?
Congressman Woman Waters, yeah. I mean, I've seen varying things that that it could be bad, and then again, some banks think they can work with the Congresswoman. So I don't. Where are you on that, Marty? It's more uncertainty, I guess.
It's more uncertainty. It's more headline risk. If you find yourself like Wells Fargo or Goldman Sachs in the headlines and reason to have to answer questions, it definitely is going to be a deterrent to your valuations that you'll have to work through over time. But again, it'll be a forum for them to be able to explain again what the kind of strength that they've also created. The financial system and the banks have 3 times more liquidity, have increased their capital ratios, and has increased the way that they look at their stress test much better than what we had in 2008. So getting that message out and having a forum to do that won't be bad either.
You know, Marty, I listened to your explanation as to why the financials across the board have gone down in Goldman Sachs. Goldman Sachs sounds a little bit like an idiosyncratic story. But should we be concerned on this side of the ocean about exposure by any of these banks, to Europe? And I ask you this because obviously the European banks are trading horribly. Deutsche Bank is down 60%. And there's really no good explanation as to why U.S. financials have taken such a beating when the fundamentals, as you outlined, are pretty decent. Earnings are pretty decent. What's going on here?
Well, really what you have to look at, we've got to go back to that transition. What investors are telling me is twofold. Look, we're 10 years into this, expansion. The recession has to be coming. But that internal clock can be wrong. And what we've seen in this expansion is that the internal clocks have been broken. It's much slower, much longer than what we've seen. So we have an index that says that, we have a 2-year clear path that we're not going to see that recession. So that's the first thing. The second thing is if I have that risk and I don't have clear catalysts to push, earnings higher, and they don't see these new catalysts yet, they don't see the full effect of the capital deployment or of securities portfolios having an historically wide yield from market rates to portfolio rates, that those things are going to start to show the positives in 2019, just like what we saw when they questioned, well, deposit rates are going to lag and we're going to see the benefit in 2017. They questioned that, and then it happened. 2019 is going to look a lot like what we saw back in 2017.
Marty, very quickly, your top pick of the big caps?
Well, if we're going to say super regionals are in the big caps, we think that SunTrust is positioned really well with the geography that they're in, the ability to generate loan growth. So we really like it, and then look at the ability for them to hit on all cylinders that we're talking about here in the positive catalyst next year.
Okay.